A lot of finance enthusiasts have been trying to forecast the next big crisis. The Great Recession of 2008 taught us about the damage a housing market crash can cause. It initiated a chain reaction that affected the U.S. economy and had a global impact. Since then, many experts have tried to spot the next economic bubble but haven't succeeded. The 2008 disaster remains unprecedented to date. However, recent indicators are suggesting a budding crisis that's widely being ignored. This impending danger could be even more destructive than the 2008 crisis, potentially matching some of America's worst financial catastrophes. So subscribe to the channel, like the video, and let's get to the point. If you've been keeping an eye on the finance sector, you may have heard something about the troubles that New York community banks are having, particularly with loans that aren't being paid back. At first, you might think it's just something that's happening to a small regional bank that not many people are paying attention to. You might even ask yourself if it's worth paying attention to. However, if you look more closely, you can see that what's happening at this bank might actually show what's going on in the wider U.S. economy. It's a bit like a warning sign. Let's rewind a bit to get a better idea of what's going on. Back in early 2020, before March, Union Bank in San Francisco decided to sell its main building. The building is in the middle of the busy city center. They were asking for $250 million, which seemed fair at the time. Fast forward 4 years, and the same building is sold for about $65 million. That's a huge drop of 74% in just 4 years, showing a big change in the market. This isn't just happening in San Francisco, though. It's happening all over the U.S. It's now known as the commercial real estate depression. This all started after 2020, when a lot of people started working from home. It's been made worse by crime rates going up in many big U.S. cities. This commercial property value drop is happening from the West Coast to New York City. These changes are having a significant effect, changing what city centers around the country look like. With more companies embracing work from home or mixed business models, the need for office spaces has drastically dropped. This leaves property owners and investors trying to understand the new normal. This downturn in the commercial property market clearly reflects the wider economic and societal changes that are changing our work environment and locations. These swift changes have caused significant disturbances in the banking sector, which are just starting to make headlines. Considering these events, there's an increasing agreement that these challenges might be bigger than what was initially thought. Let's talk about New York Community Bank, a regional titan with approximately $111 billion in assets. It may not compare to giants like Chase or Bank of America, but it's still a recognizable institution, ranking higher than many banks you're familiar with, such as Deutsche, First Horizon, and Core. However, their stock price took a significant hit after a surprising earnings report on January 30th, 2024. It fell from $10.38 to $6.47 per share, a shocking 37% drop in just one day. Since then, the bank's stock price further plummeted to $3.74, a staggering 64.4% decrease from its value just a fortnight ago. This recent downsizing is even more severe than the decline seen during the 2008 financial crisis. Numerous experts are alerting us to a looming threat hidden in the large-scale structures of commercial offices, apartments, and retail malls. The highly reputed Warren Buffett recently raised similar concerns. He specifically indicates commercial real estate as an area of potential risk. Mr. Buffett shares that many investors in this sector have expressed worries about potentially reaching a crisis point.
We have had lots of investors in commercial real estate who have come in and said that this is going to be a crisis point, that the government is going to have to step in, that something should be done because there are so many commercial real estate loans that are coming due between now and 2025, and that they won't be able to get credit from the banks in the same way to renew or to, once those maturities come due, to refinance.
Well, let's say they lose $100 billion in the banking system. Most of the banks can take that loss, their share of that loss, and a few of them, because they did other things, their shareholders will end up losing the money, but the depositors won't lose money. But if you lend money to somebody and it comes due and they can't pay, the old story about the banker, I never made a bad loan. Of course, some of them turned bad after I made them. I mean, and that's exactly what happens in, whether it's in commercial real estate. And if money rates are 2%, or we were lending money out at 4 basis points at Berkshire to the federal government, not much more than a year and a half ago or something like that. And if those rates change, let the person who bet that they wouldn't change lose money. I mean, that's if you make mistakes in business, plenty of people make mistakes. You pay for them. If you've got a big profitable business on top of it, which a good many banks do, you take your losses and you keep going on. I mean, banks can take a lot of loan losses, but they can't take something that wipes out their capital and expect the world to ignore that fact.
Meaning that you don't think anything needs to be done on the commercial real estate front?
Well, I think that the people who lend too much money should take losses, and they're getting properties handed back to them now. I mean, within the last month or 6 weeks.
Banks are.
Yeah, I mean, they got some office buildings in Los Angeles, and Blackstone walked away from something. I mean, and if you get a non-recourse, everybody goes in the real estate business is told the first rule, the second rule, the third rule is never sign your name to anything. And so you have non-recourse mortgages, and they're going to walk away, and the bank's going to get stuck with losses, and maybe they'll hold the property a long time, and it'll come back. And there's all kinds of ways that if you got capital strength, you may decide, well, I'll just hold it, but that money is sterile for quite a while, and that's part of banking. I mean, you expect to lose some money in banking.
They foresee that government intervention may become necessary. The major concern lies in a multitude of commercial real estate loans due for repayment by 2025. The investors fear that banks may not extend credit similarly for refinancing when these loans mature. If there's a loss of $1 billion in the banking system, many banks could absorb their share. However, due to their other commitments, certain banks could see their shareholders bear the loss while the depositors remain unaffected. The real issue arises when a loan is due and the debtor is unable to repay. This could lead to a chain reaction, causing a ripple effect throughout the entire banking system. This happened in the financial crisis of 2008, which was triggered by subprime mortgage defaults. The same scenario could potentially occur with commercial real estate loans. In the commercial real estate sector, things can vary. For instance, not too long ago, about a year and a half ago, Berkshire was lending money to the federal government on 4 basis points when the money rates were just 2%. If there's any shift in these rates, those who gambled believed they wouldn't change. They will certainly face financial loss. Mistakes in the business world are not uncommon. When one occurs, if you're running a profitable business like many banks are, you absorb the loss and continue going forward. Banks are capable of handling numerous loan losses. However, they cannot endure things that obliterate their capital and think the world will turn a blind eye. In the context of commercial real estate, there's no urgency to take action. Those who have earned excessively should accept their losses and take over the properties handed back to them. In recent times, about a month or 6 weeks ago, banks have acquired some office buildings in Los Angeles and have also witnessed Blackstone walking away from a deal. Thus, if you have a non-recourse loan, then it's always wise to return the property if you're struggling to pay off the debt. While looking at the data for 2023, it appears that only 30% of commercial real estate loans in the office sector were paid off, leaving over 70% unpaid. This indicates serious problems for this industry, raising questions about its future prospects in 2024 and beyond. Commercial real estate leases usually last between 3 to 5 years, and sometimes up to 10 years. For this reason, the full impact of these financial issues might not be clear yet. What's worrisome is that we might just be seeing the tip of the iceberg. The real trouble surfaces as these loans get closer to the maturity dates. Therefore, we mustn't overlook the possibility of encountering bigger problems down the line. We might just be starting to understand the far-reaching effects this could have on the commercial real estate market. More trouble could be on the way as more loans come due. Banks are extremely sensitive to this scenario, as the failure of even a few properties to repay their loans could create a domino effect that disrupts the entire system. As we begin to see the first significant price drops, it's clear that the system is under extreme pressure. Could these issues within commercial real estate be the trigger for a wider economic downturn? Share your thoughts in the comments below.